Thank you for that very kind introduction, Tim, and thanks everyone for joining us this morning. And I want to say particularly thank you to our hosts at Morgans. As Tim said, I've been with Soul Patts now for, this is my 20th year, and for that entire 2-decade period, we've had a very strong and close relationship with the Morgans team, and we've certainly appreciated their support over the years. And as Tim mentioned, this is the celebration of our 120th year as a publicly listed company. That makes us the second oldest continuously listed company on the ASX. And obviously a lot of people appreciate that the foundations of the business were in pharmacy, but as of a couple of years ago, we actually sold out of our last remaining interest in Australian pharmacies, and today we are a 100% Australian diversified portfolio of various different asset classes. Current market cap's about $11.5 billion. We're an ASX 100 business with over 60,000 retail shareholders, which we're very proud of. So while the company has evolved over the years, one of the things that has remained the same is our purpose, and that is to build enduring value for our shareholders. So we've created a unique investment product in the Australian market, one where investors can get access to a diversified portfolio of different investments, but also different asset classes that perform throughout the cycle and have delivered above market returns for decades. Our objectives are, there's three. The first one is to obviously grow the portfolio and increase the capital value of the underlying portfolio over time, to increase the cash generation from the portfolio, and that's what enables us to pay dividends year on year. And thirdly, to manage investment risk, because it's one thing to deliver higher returns, but it's another thing to do that whilst also managing the risk and protecting the downside from any kind of capital loss. How do we do that? Our approach is that we are disciplined investors, and we challenge ourselves every day to make intelligent decisions, and obviously everybody wants to do that, but it is quite difficult to do sometimes, especially when it's contrarian in nature and you are swimming against the herd, or I should say running against the herd. We also have an unconstrained mandate, and we're blessed with the ability to be able to invest in anything at any time that we think makes sense, and our flexibility is really key to our performance. We are truly diversified, and I'll talk a little bit more about this in future slides, but what we talk about when we think about diversification is not merely owning lots of the same thing. It is genuinely owning things that are different, that perform differently to each other, and that not only reduces risk over time, but also improves performance. We are long-term in our focus, and that's really important because a lot of decisions are influenced by short-term events. We invest to grow and build businesses over time, and we identify long-term thematics that we like to back, because our belief is that even average businesses can perform quite well if the industry tailwinds are supportive. And again, that long-term focus is about looking through the short-term noise. But long-term doesn't simply mean that we buy and hold for the long term. I mean, there's certainly lots of investments inside our portfolio that have been there a long time, and it's important to be able to ride those good investments and not sell out too early. But our portfolio is far from set and forget. We're extremely active. We did about $3 billion of transaction activity across the portfolio in the last 12 months, and we're always looking for the next great opportunity. And lastly, we aim to be trusted partners, and we seek to differentiate ourselves on the basis that people want to do business with us. People identify us as the kind of capital that they want to partner with, and look to us to be long-term supportive partners with them on their journey of growth. So for those reasons, our reputation is extremely valuable to us, and it's one that we've built up over a long time, and something we hope to continue. So I mentioned that cash generation from the portfolio is very important. We're proud to say that we've never missed paying a dividend since listing in 1903. And if you look at this chart here, since the beginning of this century, we are the only company in the All Ordinaries Index. There's about 500 companies in the All Ords, and we're the only ones to have increased the ordinary dividend every year. The compound average or annual growth rate across that 20-year period, or nearly 23-year period now, is 8.5%. But what's particularly pleasing is that if you look at the final dividend that we paid last year, that was up over 19%, which was quite a big increase from what we've seen in recent years. And the interim dividend this year was up 24%. So what that's telling you is that the board feels very comfortable about the outlook for our cash generation across the portfolio, and that has enabled us to step up the dividends in that way. Because obviously that's a track record of increasing dividends that we'd very much like to continue. So if I then look at the total shareholder return that we've generated, we tend to focus on the longer term. There's certainly been some good TSRs in the last little while. I mean, certainly the last 1 year has been strong and 5 years has been strong, but I've highlighted the 20-year box there because that's where we tend to focus. So over the last 20 years, the outperformance that Soul Pattinson has generated for our shareholders has been 3.7% per year. Now, 3.7% might not sound like a lot, but when you compound that out, the market has done about 4.8 times if you invested in the market over that 20-year period. But if you'd invested in Souls, you've done over 10 times your money. And what's particularly pleasing about that outperformance is it was during a period, certainly recently, where growth has been performing quite strongly in the market. And what we've graphed here on the left is the value index or the growth index over the value index on the ASX. And you can see that in the first 3 years, from 2012 to 2015, we had value performing quite strong, and at its peak, I think the value index was about 40% higher than the growth index. But then between 2015 and 2020, that position reversed, and growth took a 60% lead over value. And so at its peak, the average PE ratio of the growth portfolio was around 17 times more than the value index. And that compares to an average differential of just 3.6 times across that whole period. And so if I look at it right now, the growth index has a PE differential that remains about 8 times more than the value index. And as you can see on the graph on the right, real interest rates have continued to fall since 2012, and they're quite negative at the moment, which is quite accommodative in terms of business activity. We think that will eventually come to an end, either through inflation dropping or interest rates continuing to rise. We think that the period for value investors will come again. And so, as I said, even though we've performed quite well through a period where the market has rewarded high growth companies, we've tended to stick to our knitting, which is around a defensive portfolio of traditional industries that are asset-backed, cash generative, and perform in all parts of the cycle. And we continue to be defensively focused in our approach. If I look at this, this is a bit of a complicated slide here, but the summary is that over the last 20, this is data for the US, and over the last 10 recessions, the average decline of EPS across the market has been, if I exclude the GFC and the tech bubble bust, the other 8 recessions have seen EPS across the market drop by nearly 19%. So, I guess we're not necessarily saying that's what's going to happen in Australia, but I think our market conditions are more supportive, given that we have a strong bias towards resource stocks and large bank stocks. So I'm not saying that the market will drop 19% in terms of EPS, but the market does go negative, and it's something that we particularly think about when we position our portfolio. And despite the fact that the Australian market hasn't had a recession for a very long time, or at least not a real recession since the very early 90s. The market does go down. So if I look at this graph on the left, there's a histogram of monthly performance of the ASX. And so over the last 20 years, it's been, of the 240 months, 82 months have been negative. And the average market performance of those negative months has been minus 3.5%. But our portfolio tends to do a lot better in those months, and so the average performance of Soul Pattinson in those negative months has been almost 2.1% better per month than the market. And you can see that there's even been 15 months there where the market has fallen by more than 6% in a single month. So I talked about diversification, and there's a few sort of angles to the way that we think about diversification. As I said, it is not about having lots of stocks that are the same and perform the same. We think that a few uncorrelated assets is enough to that are uncorrelated and perform differently is enough to genuinely reduce your risk and increase your performance. And in fact, by adding lots of different investments into your portfolio, you're just diluting your best return, your best ideas. And so we think that you should have concentrated bets in things that you honestly believe in, and then match that out with other uncorrelated assets that protect your downside. So if we look at this slide here, where we've got a hypothetical portfolio one, where we started with $500 million of assets across 5 different assets. Asset 1, 2, 3, 4, 5 are each doing 10% per annum. So the weighted average annual return for that portfolio is 10%. Portfolio 2, also starting with $500 million portfolio, but in this case, Asset 1 performs 0% per annum. Asset 2 is 7.5%. Asset 3, 10%. Asset 4, 12.5%. Asset 5, 20%. Again, the weighted average annual return is 10%. So instinctively, you think that these portfolios are going to perform fairly consistently. But what we see over time is that portfolio 2 significantly outperforms portfolio 1. And in fact, over 20 years, portfolio 2 is worth over $6 billion, whereas portfolio 1 is worth just under $3.4 billion. And so what we see is that the strong performers in your portfolio more than make up for those parts of your portfolio that are underperforming. And so it's really important to us to make sure that we not only find those investments that perform very well, but ride on that journey with them for a long time. So if I look at our portfolio today, there's nearly half of our portfolio is in what we call the strategic portfolio. And the biggest assets in that portfolio are TPG, New Hope and Brickworks. All of those assets have been inside our portfolio for a number of decades. And certainly TPG and New Hope have been those kinds of assets that have performed more than 20% annualised returns. So that's where we've got a lot of our growth from. And then if I look at Brickworks, and one of its major assets is Soul's, but also the second biggest asset it has is industrial property, and that's been an asset class that's returned over 20% for Brickworks for some 15, 16 years that they've been investing in industrial property. Looking down the list, there's $2.8 billion of our portfolio in large cap listed stocks. Now, we've been selling that portfolio down this last 12 months, primarily to fund some of the other activities that we've been doing in the portfolio. And so year to date, we've reduced that portfolio by $670 million. And this was one of the great benefits that we got from the merger with Milton a couple of years ago. It not only increased our scale and the liquidity of our shares, but it gave us the liquidity that we need to invest in the new opportunities that we're seeing and to further diversify our portfolio. So where have we been putting the money? Our private equity portfolio as at 30 April was about $850 million. We've invested nearly $200 million in that portfolio year to date, and that's really been across all of our platform assets that we have in that portfolio. Our biggest asset is in agriculture, and we're focused on horticultural assets, high quality food that mostly for export. And that's a very exciting opportunity for us. We did a thematic exercise where we looked at what are the industries that are going to benefit over the long term in terms of food scarcity and Australia's importance in terms of being energy, food security and a supplier to the Asian region. But in addition to that, Australia's greatest competitive advantage is actually in agriculture. The other asset that we have is Control, which we bought the other 50% of about 12 months ago. That business is an electrical engineering business that we think will capitalise on the energy transition that will take place over the next few decades and the renewal of the grid and all of those sorts of things. That's a very exciting opportunity for us to grow that business, but also to bolt on other things that can benefit from that thematic. We've also been investing in our swim schools. So we started with a Brisbane-based swim school provider called Aquatic Achievers, and we've now been both growing that business through organic and inorganic means, and we've just bought the New South Wales Carlisle swim school business. So we're getting that business up to scale, and that's a very robust, resilient and cash generative business, so we're very excited about that. And then the other theme that we're exploiting in our private equity business is wealth management, and we've got an investment in Ironbark, and again we've been putting some more money to work in that. The other portfolio that we've been putting quite a lot of money to work in is what we're calling structured yield, and structured yield is our name for what is effectively credit to Australian corporates. That portfolio has grown significantly in the last 12 months. It's up to about $680 million now. We put $470 million into that portfolio year to date. There's another couple of $100 million of undrawn commitments, so we're getting very close to the $1 billion mark in terms of the size of that portfolio. The reason why we like that portfolio is the opportunity right now is fantastic. We're getting really strong interest rates. There's dislocation in the market in terms of companies' access to equity, but also access to debt. So that portfolio is returning an average cash yield of nearly 13%. And the beauty of it from a risk return perspective and a capital protection perspective is obviously the downside protection that comes from investing in the credit part of the capital stack as opposed to the equity. So, we look at it and we're seeing better than equity-like returns, but obviously with that additional risk protection in a sense that equity has to be effectively wiped out before you see $1 of credit loss in a debt position. And then there's been $250 million of additional cash put into the portfolio, and that's primarily a defensive stance that we've taken. We're hoping that there will be a little bit more volatility and an opportunity for us to take advantage of new things that might come our way. So, we think that the portfolio is really well positioned for the current market and the conditions that we're seeing. I don't want to sound too pessimistic when I talk about recessions and things like that because, we don't know that that's going to come. And if I look at the US, I think the bond markets are pricing in about a 90% chance of a recession in the US, but in Australia it's only about 50% chance. And as I said, our resource and strong banking market will prove to be more resilient than some other markets in the world. But I guess the point that we're taking, the point that I'm making is that we're kind of hopeful for the best, but prepared for the worst, and our portfolio always does a lot better when markets are more negative. And so if I look at how does our portfolio perform against other asset classes, and again, I don't want to be pessimistic because I think if you take a long-term view, it does pay to be taking risk and being invested in equity markets over the long term. So if I look at Australian bonds, and if I'd invested $10,000 in Australian bonds 30 years ago, that would have grown to just over $50,000 for a 5.6% annualised return. If I'd invested $10,000 in the Australian REITs, that would have grown to about $90,000 for a 7.5% annualised return. If I put it into international shares, now that's the entire global equities market ex-Australia, 10,000 will have grown to 91,000. And the Australian market is a very strong performing market. And over 30 years, it's done 9.4% per annum total return. So $10,000 has become just shy of 150,000. But we're really pleased to say that if you put $10,000 into Soul stocks 30 years ago, the total return would have given you about $416,000. So with that, I'll stop there and open it up to questions. But thank you very much for listening.